Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Alexandra Canal. Let's get you up to speed on the market action with 1 hour left to go in the trading day. We are seeing just the Nasdaq up right now in the green, up 37 points. The S&P 500 looking to eke out a fifth straight day of gains right now, but trading pretty flat, and the Dow down 137 points. This coming on a day where we got the personal consumption expenditure. That is, of course, the Fed's preferred inflation gauge, showing inflation still well above that 2% target. We saw it climb 3.3% in July year on year, 3% from the previous month, but still above that 2% target. And we are, of course, watching yields on the back of that. We did see a pullback in those Treasury yields. Taking a look at where the 10-year yield right now, it is trading just above that 4% level. Oil also in focus right now. We've seen oil pushing higher right now, up about more than 2%. This coming even as the latest data out of China pointed to further slowing there, with factory activity contracting for a fifth straight month. Ali.
Yeah, Kiko, and it is the final trading day for August. Markets are fighting for gains, looking to extend a 4-day win streak. Jared Blikre is at the floor of the New York Stock Exchange with the details. So, Jared, can we do it?
We're doing pretty well, Ali. Let me take you to the Wi-Fi Interactive, where I am looking at the VIX. This is a fear gauge. It is down, looks like for the fifth straight day. And let me just pull up a year-to-date chart. You can see it has really crashed down near two support levels that we had about a month ago. And with the lower VIX, that means we have elevated equities usually, and that's what's happening today. But since it's the end of the month, I wanted to broaden out the discussion and talk about what happens to the VIX going into September and October, because that's when it tends to spike. So this cyan line that I'm tracing right now in green, that's what the VIX has done this year. And you can see it ticked up in August. We had that negative month in stocks. And then on average, those are the purple bars, it tends to go up. So a lot of these averages are brought up by the fact that we have a number of crashes historically in the months of September and also October. Black Monday, 1987, 9/11, the global financial crisis, Lehman Brothers was in September. So I did also do some data mining, which I overviewed yesterday, which says that stocks, when they're really up big through July and then you have a negative August, that actually eliminates all the crash years from our criteria. So September and October, who knows? We might fly by with nothing more than a little hiccup or a correction here, but we do have to be on alert. I'd like to spend the rest of the time here just going over some heat maps for the month, starting with the sectors action. And you can see XLE Energy is the only one in the green for the month of August, which has 23 days, by the way. That's above the usual 21. The defensive sectors of utilities and staples, those are the worst off. And let's take a look at the leaders here. Pretty instructive, because only cannabis, which really looked alive over the last few days with the DEA potentially rescheduling it, that's up 10%, but aside from some energy and momentum names, everything else in the red. Memes, the hardest hit, down 17%, followed by solar and disruption. And let's just peer into some of these different groups here. For instance, here is disruption. Here's the ARC Innovation ETF components, at least some of them. And you can see just a sea of red, Square down the most, and Roblox each down about 27, 28%. Tech not having the best month, but NVIDIA, not surprised, that is up 6%. Broadcom also up 2%, but for the most part, chip stocks taking a dive. Software, the other component of tech, that looks a little bit stronger here. And now I'm just going to cycle through some of these different sectors kind of quickly here with about 20 seconds left. Here's travel, aside from Booking and Marriott, everything in the red there. Industrials, mostly red, although we do have a couple of green names there. And then what were people doing in their spare time over the month? You take a look at fitness. Were they exercising? Not necessarily. Gaming. Were they staying inside and playing Nintendo? Not necessarily. Gambling? No again. Beer? No. Weed? Well, there you have your answer. Cannabis, one of the few sectors in the green over the month of August, guys.
Oof. Well, Jared, let's hope September is a bit better than August. I know you'll keep us posted for that. Jared Blikre, thanks so much.
Well, we are seeing shares of Okta soaring, up more than 12% after beating the street's expectations in the second quarter. The cloud company hiking its full-year outlook by almost a third. And one of the big points here, the increase in annual contract value, or ACV. Okta adding 125 customers with $100,000 plus ACV, bringing the total number to 4,000, and the total value of the top 25 deals in the quarter, more than $100 million. Joining us now is Okta CFO Brett Tighe. We've also got Yahoo Finance's Brad Smith joining in. Brett, this is quite the turnaround from where you were a year ago, and we see Wall Street cheering the results. How much of this do you think has to do with the shifting macro environment? How much of this is about execution for Okta?
Yeah, this is really on the back of a great team effort, right? The team did a great job executing. The macro does still tend to be a headwind to us. We talked about how the macro did stabilize in the quarter. We did have great execution results. You talked about it, really good big deal quarter. We closed a lot of large deals, one of the best we've ever had as a company. But strong growth in the top line. You can see, revenue growth growing 23%. Also really strong on the bottom line as well. We set records for non-GAAP operating margin, 10.6%, gross margins at nearly 80%. So we're really pleased with the outcome. And we feel like there's some good momentum in the business as we enter the second half of the fiscal year.
Brett, perhaps you can take us into the pulse of what you're hearing from the sales team over at Okta as well. As you had talked about it on the call, new customer growth, an area that you believe is being impacted by the macro environment. And so even as you're having these discussions with potential net new customers, even if they're pushing out some of their larger purchases, when are they asking to be re-engaged with? Check back with us in a year, or is it 18 months? And how do you kind of evaluate where you can start to see some of those potential deals really start to come forward as well?
Yeah, definitely the macro is impacting the new business side of the house. We've talked about this over the last couple of quarters where, our pipeline build, our sales tend to be more upsell focused because it's a little more challenging in a down economy to enter into those newer vendor relationships. I mean, I know from our side, we have the same challenges as well when we're engaging with new vendors. You want to, focus on, those relationships you've already got. But ultimately, identity is a very key strategic initiative for a lot of companies out there. So whether it's today or it's tomorrow, identity is just growing in importance. And in the long run, we do believe.
Okay, Brett, looks like we just lost your connection there, Brett Tighe with Okta. Thanks so much for joining us.
Well, we're watching shares of Signet Jewelers rising today after the company reported better than expected results on the top and bottom lines and reaffirmed its full year guidance. Joining us now is Gina Droso, Signet Jewelers CEO. Gina, pretty solid quarter here, and you guys are looking ahead to an even stronger engagement ring season. I'm curious, though, what changes, if any, you're seeing on the consumer side when it comes to the purchase of those engagement rings, with lab-grown diamonds becoming more and more popular. A lot of consumers looking to that as an affordable option. Are you seeing consumers trade down to that or perhaps smaller carat sizes?
Well, we've seen a number of things on the consumer front. We think the customer stays cautious through the holiday season. Over the last couple of months, though, we have seen some modest increases in traffic, and we've seen some resurgence in low-priced fashion. That's actually a good sign. That's self-purchase as women are going back to work, kind of a back-to-school feeling. That typically bodes well as we go into holiday. And then in terms of engagement, we're really in a one-year lull in 2023. This is the trough of what happened 3.5 years ago, which is that COVID disrupting dating. And so we're seeing less engagements this year by about 25% versus normal. That trough happens in the third quarter, and we expect it to begin to come back a bit in the fourth quarter. Lab created is more a part of customers' purchases now. It's actually a very nice innovation for a more value-conscious customer, but we're not seeing trade down. For Signet, we actually see a higher average transaction value and a higher margin on lab created versus natural.
You mentioned the rebound that you're seeing in lower price points. I wonder how that sort of sets things up for how you think about pricing right now. I mean, does it lead to additional discounts, or is it really about sort of meeting the consumer where they are in terms of the products you offer?
We're really answering that through our assortment right now. We have a great breadth of assortment across our different banners. We have Banter that typically plays in a lower price range. We've tiered up our Jared business significantly, so we're carrying quite stylish, high-quality pieces in that banner with Kay and Zales in between. We also now have Diamonds Direct, Blue Nile, James Allen in our portfolio. And while those three businesses skew more toward engagement and bridal, they also have very nice fashion assortments. So our assortment is broad. We will use strategic promotion to drive traffic, to get customers into the store. In a macro environment like this, they're often waiting to get the best value, but we'll be able to bring them that great value throughout the season.
You mentioned getting customers back into the stores. In terms of digital versus brick and mortar, are you seeing a clear preference among the consumer? And with that brick and mortar, do you anticipate needing to close more stores down the line?
So we've seen a big shift in how customers shop for jewelry over the last several years that we think is a permanent shift. So now we see close to 80% of customers start their shopping journey online. They're researching, they're going to different websites, they're becoming educated about styles and also about different carat weights or different colors of gold, that kind of thing. And then we see them come into the store for the kind of expert consultation that a company like Signet is great at providing. We really believe that our jewelry consultants are a competitive advantage and build, they have great expertise, and so they build a great trust relationship. So while almost 80% of customers start the journey in store, only 20% of them, started online, only 20% transact online. Most are transacting in the store.
So what does that mean for your brick and mortar footprint? I mean, earlier this year, you announced 150 store closures. Is there more to come, or are you pretty comfortable with the number you have right now?
We are always looking at the opportunity to optimize our store footprint. We'll be closing out of that 150 mostly low-performing mall locations in both the U.S. and the U.K. We also announced that we were opening about 30 or 35 new doors. Most of those are large footprint doors, like a Diamonds Direct or a Jared. So actually, our square footage stays about the same, but we believe that we're better positioning the store.
Gina Droso, Signet CEO, thanks so much for your time.
Thank you.
We want to get back to Okta, as we were saying earlier, that shares there up more than 12% after the company beat the street's expectations in the second quarter. I want to see if we can bring back in the CFO of Okta, Brett Tighe. Brett, it looks like we got the connection back with you. We were talking earlier about the incredible growth that you saw in your quarter. And, this comes at a time when we've heard from a lot of companies, a lot of tech companies, about the pullback they've seen in investing in terms of digital infrastructure. Obviously, cybersecurity included in that as well. But I wonder what your results tell you about how businesses are prioritizing that kind of investment in this type of economic environment.
Yes, I mean, the macro is still a headwind for us as well. But look, identity is a strategic component of any tech stack out there. You've really got to focus on this, like you're talking about with cybersecurity. It's a key component of securing your workforce identities or securing your customers, which is our customer identity tool. So identity continues to be strategic now and into the future, and we're excited about the opportunity as we're moving forward.
Brett, as with any tech company right now, investors want to hear what you're doing with AI. And when you see the generative AI kind of hype phase and really some of the investments that your business has made really coming to fruition in terms of the financials, what does that timeline look like? And is that something that you're seeing pick up and rev up in terms of demand?
Yeah, look, we're excited about AI. The bottom line is the more AI there is, the more tech there is, the more identity becomes important, right? I've just been talking about how strategic it is. We believe with AI, it becomes even more strategic. We're actually going to have our user conference, our annual user conference in October. We're actually going to be talking about additional products on the AI front. So I would invite anyone to attend that. It's an exciting event where we talk about all of our new product releases, and we'll be talking about some AI product releases coming out at that time frame as well.
How are you looking at those product offerings? I realize you want to kind of save some of that until your big launch there, but you mentioned just how AI is expanding the scope of your business, specifically around identity protection. What does that offering look like, or what does that strategy look like?
I don't want to get too far in front of ourselves. Obviously, there's a lot of interesting announcements that are coming out, but once again, we do believe that the more AI out there, it means more connections, more identity matters, and so we do believe it'll be a long-term good thing for us. Just like some of the other macro trends we've been riding around, the cloud shift to cloud, digital transformation, zero trust security. We believe it'll be one of those big mega trends that will help our company not just today, but also in the medium and long term.
Brett, for investors perhaps that are watching this show right now, they know that you've taken a lot of actions, this got brought up on the earnings call as well, to really kind of reduce some of your cost structures, increase efficiency as an organization, and expecting that to benefit margins, as you said, this year and beyond. What does the normalization of that margin profile look like for the business?
Yeah, look, our goal is the same goal we've had for a very long time now, which is to balance the growth and the profitability of the business. So we're going to continue to profitably grow this business over time. I can't give you the exact numbers, but ultimately our goal is to grow the top line in a healthy way while also balancing the margins. You saw it in the quarter, 23% year-over-year growth, 10.6% non-GAAP operating margins, healthy free cash flow margins we're expecting for the full fiscal year. And so we're going to continue to manage the business through that lens of balancing profitability and growth at the same time.
Finally, Brett, I've heard you talk about sort of this macro environment as a headwind, but really it has been quite the turnaround for Okta when you think about where you were a year ago, thinking about all the analyst calls that came out then with downgrades. Is it safe to say you're kind of past the lull, past the low of the cycle?
In terms of the macro, right now we see it stabilizing. I can't say I'm a macroeconomist, so we'll see how it goes over the next couple of quarters. But we are expecting the macro to continue at this in this kind of headwind, this range for the back half of the fiscal year.
And with that in mind, how much selling into your existing portfolio and client base do you imagine can sustain the business while you are trying to make sure that you're bringing on net new customers and seeing some of the overall ACV continue to move higher?
Yeah, we've got a very large opportunity just in our own customer base. We've got over 18,400 customers at this point. So, and I would say we're still fairly lightly penetrated in a lot of them. So there's a lot of opportunity in the current customer base, but there's also a tremendous amount of opportunity in the folks who are not customers right now. And so we need to find a balance over time to be able to add new customers, but also, address the use cases of the customers we already have. So we're optimistic about everything as we go forward.
Okta CFO Brett Tighe, appreciate you joining us today, and our thanks to Brad Smith as well for joining in on the conversation.
Thanks for having me. Have a great day.
We're just getting started here on Yahoo Finance Live. Coming up, little relief for home buyers. Mortgage rates tick down this week but remain elevated. We're going to give you the latest housing hurdles later in the hour. And childcare may be coming to an airport near you. Find out which facilities are trying to lure workers with daycare perks. And actors are finding new opportunities to make money amid the ongoing strikes. All of that and much more when Yahoo Finance returns.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Let's check in on some of today's top trending tickers. Shopify stock rising amid its partnership with Amazon that will bring Prime shipping and delivery to Shopify merchants. Shopify can now offer Prime benefits to their customers for the first time while also staying on the Shopify ecosystem. And Akiko, this is a really interesting partnership considering these two are competitors, but it does seem like this could be a win-win. You have Amazon, which is one of the biggest, if not the biggest, online retailers, really strong brand recognition, that trust with consumers, but merchants have become frustrated lately when it comes to some of the stricter terms that Amazon has, and now that they're able to partner with a company like Shopify, which does have that strong relationship with merchants, they'll be able to capture some of that gross merchandise volume and increase the value of that Prime membership, since merchants can then expand to different sites, and in turn Shopify can increase that merchant usage on their own platform. So again, just feels like a win-win here.
Yeah, I mean, buy with Prime. Initially, remember, Shopify was kind of against that for their own merchants. So it's an interesting partnership. I guess if you can't beat them, you join them. I think the commentary coming out of Barclays analyst Trevor Young is sort of interesting. You know, we're looking at Shopify, those shares obviously seeing a big bump on the back of this. He says this kind of removes a big overhang for Shopify shares. But for Amazon, what this means is being able to tap into additional data from these merchants that they otherwise would not have sold on Amazon. So that's another expansion of the data for Amazon. As you know, it really is all about that, how they're able to target specific customers with that data they have. So a win-win on both ends, it appears, although Shopify shares seeing the bigger bump today, up roughly 11%. Well, shares of Dollar General in the red after the discount giant cut its profit forecast amid weak traffic and the ongoing slowdown in discretionary spending. Dollar General's second quarter net income saw a significant drop from the previous quarter, and the retailer now sees fiscal 2023 sales growth between 1.3% and 3.3%. That is down from prior guidance as high as 5%. There's no real silver lining here, Ali, when you think about the numbers that came out of Dollar General today, especially when you consider the environment they're operating in. Consumers are increasingly seeking value. They're seeking discounts. You would argue this is kind of a good environment for Dollar General to be able to operate in, but at the same time, they are facing so much competition from not just Dollar Tree, but also the likes of Walmart that offer more variety, that offer discount, that offer value. Dollar General just not able to compete with that right now.
So true. And even within that lower income, product offering, we are seeing consumers shift to lower margin goods. They're just shifting their spending behavior overall. And then you also have inventory gluts. All of this coupled with the macro environment, certainly not painting a pretty picture here. And there's potential for things to get worse. Analysts are warning that we could even have more inventory troubles down the line. We also have shrinkage, retail theft. That's a story that's really affected all of the retailers. So we'll see if they're potentially able to bounce back ahead of that critical holiday shopping season. Shifting gears to AMC, I'm tracking those today because they're seeing a bit of a boost thanks to Taylor Swift. Taylor Swift's record-breaking billion-dollar Eras Tour will premiere in theater chains across the U.S. on October 13th. And it's not just AMC, although wow, Shares are actually flat right now, but they were up as much as 6% earlier today. We also saw Cinemark, IMAX, some of those other names in the space see a jump as well. And I like to think of this in the context of the ongoing writer strike. We're seeing movies like Dune 2 that got pushed from November of this year to March of next year. There's not a lot of big blockbusters in the theaters heading into the fall. So you think something like this will help drive traffic. But again, we're seeing AMC take a leg down in later trading today, although they were up earlier in the session.
Yeah, Allie, we've been talking a lot about what's going to take the place of movies and sort of content we traditionally see in the absence of, what was happening because of the strike. I wonder to what extent Taylor Swift can replicate the success that she's seen in her tour, though. I mean, it's been incredible, right? We have heard so much from all her stops, hearing about the big boost that the local economy has gotten. Feels like this is, they could get a lift on the back of it, but a lot of expectations riding on this, especially because there's not a lot in the pipeline right now for these theaters to get excited about.
It's hard to replicate a lot of things that we saw this summer, not just Taylor Swift, but also Barbenheimer, the phenomenon there. So remains to be seen. I certainly think it's going to be a pretty sleepy fall and winter, though, judging from the lack of Taylor Swift, if you will. But one theme that emerged this earnings season among retailers like Home Depot, Best Buy, and even Big Lots was a consumer cautious about spending on bigger ticket items. That includes everything from patio furniture to appliances. Yahoo Finance's Inez Frey is here with more. So Inez, it seems like consumers, they don't want to be paying the big bucks anymore.
No, not those big ticket items. And we really kind of saw it across the board when it came to appliances, when it comes to furniture as well. And you can see that some of the retailers that posted their results for this last earnings, Best Buy saying that demand for appliances, that pulled back. They did see an increase in vendor-funded promotions. Similarity also when it came to Lowe's as well. And Home Depot saw softer demand for big ticket discretionary items, citing patio, citing appliances. We even had results from Big Lots, and Big Lots said that its core lower income consumer really was under pressure and was not spending in the bigger ticket items like patio furniture sets. So this gives you a bigger picture of what's happening. Of course, that a lot of this is because of the pull forward that you saw with these items during the pandemic as consumers were at home, they were sprucing up their houses, they were buying things, they were moving around a lot, but now you've got the housing market that's basically frozen, and you have consumers that are spending more on services and less on goods. But what it's also indicating is that we are seeing some cracks in manufacturing when it comes to, at least for the furniture side, because a lot of the furniture is actually made when you talk about big dining room sets, sofa sets. A lot of that is made in the U.S., whereby they're not brought from abroad that much because you can't fit that many in these big containers. So we have seen some closures of some factories, especially in North Carolina. Last year, you saw United Furniture, which was a big supplier for Big Lots, and also Mitchell Gold over the weekend. Mitchell Gold and Bob Williams shutting its doors, and that's a big furniture company. These are private companies, but it gives you a little bit of color of what's happening with furniture, with appliances, these big ticket items, these durable goods.
Inez, what does this ultimately tell us, though, about the outlook for the labor force within that manufacturing industry?
Yeah, well, it'll be interesting to see because tomorrow we have the jobs number coming out. And last month we had seen, or the month prior, I should say, that we had seen that in manufacturing, you saw a contraction of about 2,000 jobs. That's not that much. But if you take a look at the ISM manufacturing index, you saw that it came in at 46.4 for the month of July. So that ticked up slightly, but nonetheless, the 9th straight month of contraction. And this is new orders and production. And factory employment actually dropped to a 3-year low. So what that's indicating is that we are seeing more layoffs when it comes to that manufacturing sector. So I'll be certainly keeping an eye out on manufacturing tomorrow when that jobs report comes out.
Okay, well, I'll be watching. Inez Frey, thanks so much for that.
Thank you.
Well, coming up, the housing industry plagued by high prices and propped up by low inventory. What's keeping current homeowners from entering the market? We're going to have answers for you on that and much more when Yahoo Finance returns. The Federal Reserve's preferred inflation gauge edged higher in July, reversing some of the prior month's sharp drop as the central bank works to bring inflation back to its 2% target. Core PCE rose 4.2% over the prior year in July, in line with economists' expectations, while headline PCE inflation also met expectations, rising 3.3% year over year. Joining us now for more on what this all means for the markets and the Fed moving forward, we've got Johan Gran, Allianz Investment Management, Head of ETF Strategy. Johan, it's good to talk to you today. What's your read on what the data today says about how sticky that last mile is going to be for the Fed and getting to 2%?
Well, it's been a bit sticky, but the key issue is really where we're going to go next and where the Fed is going to take rates. And they've been trying to push up now for quite some time, as you know. They've been hiking rates 11 times over the past 18 months. There will be a bit of a lag on the in terms of the effect on the economy itself. Everybody's fully aware of that, and it's just now starting to really work its way through. So the fact that we've seen declining inflation in spite of the growth in GDP that we've seen, and also the very tight labor market that we have, I think they're focusing on the fact that the trends are going in the right direction as it relates to inflation, because the full impact of the rate hikes we still have yet to witness.
You mentioned that tight labor market. We will get the August jobs report numbers tomorrow. The expectations are that those numbers will be in that sweet spot, but how sustainable is that as we head back into the back half of the year and just considering where we're at in the current economy?
Well, there's no doubt that you have some pressure building up. There is always a lot of conversations now around earnings pressure, and you have companies looking, for ways to cut costs when it becomes more difficult to keep hiking prices. Effectively, the consumer has had enough in many cases in terms of price inflation. So in case of in that particular case, you will continue to see this playing out. But the long story short here is really the fact that whether the numbers come in at the expectation, I believe it's at about 170,000 jobs, or if it's 150 or 200, will have very little impact in terms of the outcome and what the Fed is expected to do in September.
Johan, going back to what you said earlier, that the trends are going in the right direction when you consider the economic data, does that mean no more hike?
I believe so, yeah. No more hikes in September. I don't think we'll see any more hikes this year. This is the time where the Fed has earned its right after climbing high now for 18 months. They have earned the right to take a break and to institute what I would refer to as a wait and see period to see how things shake out. What they've been trying to do is hiking up this enormous mountain now for some time, and they need to figure out whether the data will support that they've actually reached the peak of this mountain, or if they're still sitting at a false summit and they need to do more. But for them to be able to make that decision, they need real confidence around the data that they see, and that will take some more time to build up, as Jerome Powell has hinted at as well.
Well, that uncertainty is certainly weighing on the consumer. We've been seeing retailers warn of a cautious consumer. In recent studies by your company, in fact, in the second and third quarters, we saw that 7 out of 10 Americans are more concerned about paying bills right now than saving for their financial future. Do you expect this trend to continue?
Yeah, it's very interesting. We've seen this throughout several quarters now. The American consumer is really quite fragile in terms of their sentiment, and you can think about it. It's kind of interesting, right? Because you have on one hand a strong consumer, people keep spending, and there is a little bit of a crack in the system here because you have, in a way, 3 different categories of consumers. You have those with enough discretionary income to say, you know what, I was holding back during the pandemic. It's time for me to spend. They might now get annoyed by, $700 airfare tickets and ice cubes in the cocktails that just keep getting bigger. But you also have another layer of more, call it the middle income class, where the dynamics are a little bit different. They've started to borrow from their future. So they're now starting to cut down on the amount of money that they're putting away for 401k savings, for example. Some of them have stopped altogether just to fund what they want to do today at the expense of tomorrow. The third category of American consumers, if you will, are those living paycheck to paycheck. And I saw today, as recent as today, there was a new article on this topic about how over 60% of Americans are living paycheck to paycheck. They have no option but to cut back as prices keep going up. So inflation is forcing them to take action. All these things are going to come through, and I suspect that we will see more of this impact over the next several months here.
On that first category you mentioned, I mean, we've talked so much about services over goods, consumers continuing to spend at least over the summer break in terms of vacations and airfare, which you mentioned. What kind of pullback are we likely to see as a result of the current environment that you just described?
Well, given the fact that you have, 65, 70% of the economy is spinning around, the service industry, this is the sector where you will see the most of the cutback. But you will also see these things, we talk about going back to school, and I have 3 children of my own, and it's not inexpensive anymore to put them back to school. Everything from pencils to new sneakers have gone up in price, and it's a pretty steep sticker shock in many cases. These realizations are slowly setting in, and it's setting in across the board. So in terms of a pullback, I think it has a propensity to be quite significant.
And in terms of the broader market, we've certainly seen the tech sector struggle this past month. But Apple had an interesting announcement this week. Their next big product launch will be in mid-September. Do you think, given Apple's size and dominance, that could help boost the overall market?
Well, it's possible, right? I mean, you see these small spikes of enthusiasm in the market. There might be a new gadget. There might be, a prime push to buy, and so those are smaller peaks. But will it carry the whole market forward? No, I don't believe so.
Let's talk about investing strategy. You've naturally pushed for ETFs over sort of individual players here. But what do you think investors should be looking at? What are some sectors that you think they should expand into or add exposure to?
Well, so I think most investors, they aim to have a pretty balanced portfolio. They're all thinking about the risk return trade-offs, and that's typically across equities, fixed income, and bonds for most investors. Very few investors are actually doing tactical trading, nor should they, because it is not easy to get those trades right, both on the way in and on the way out. So as it relates to ETFs that can help you, we happen to have buffered ETFs in our own lineup that gives investors an opportunity to participate broadly in the equity market at the same time as they have a risk mitigating built-in buffer on the downside in case the markets go down.
Are there particular buffer ETFs that you have your eye on right now?
Yeah, so we're actually there's many of them, right? So we have a 10% buffer, and we have a 20% buffer that you can invest in. And basically what it means is that it gives you exposure to the S&P 500 with an outcome period that lasts for up to a year. And with that, you can gain, if the market goes up to a certain level, but you're buffered against either 10% or 20% of losses over that outcome period. And basically, as a standalone basis, a lot of investors, advisors, and the investors, they will argue that, I'd rather give away some of that potential upside that I don't really need. I might be good with 8% or 10 or 12 or 15% if the market goes up, but I really can't stomach those losses on the downside. So I'd rather have something like this in my portfolio to combat the fact that I'm trying to preserve wealth, but also at the same time growing away from inflation.
What do you think investors should be looking to in terms of the right mix between equities / ETF, as you mentioned, versus fixed income? Given the yields, or given where yields are right now in bonds?
Yeah, it completely depends on the risk profile, right? So our investor base tends to be those that are, closing in on retirement, or they might be in retirement. That's when you tend to be a little bit more conservative. And for the longest time, for decades, it's been about moving from equities into fixed income or cash. That is a bit of a conundrum today, right? And it has been for a while. Fixed income didn't quite give you much yield to speak of, not too much income from fixed income. Now you're getting some, but is it going to really make a difference? Maybe, maybe not. And cash, of course, is being deteriorated by inflation. Now you have money markets giving you 4 or 5%, perhaps. Same conundrum as you have with fixed income. So the question really is, do you want to focus on the equity risk premium and bet on the market and the economy to keep growing over time? And one way to do that is by allocating to investments that give you exposure to it, but also provides a nice buffer on the downside.
Diversification, always a safe bet. Johan Gran, Allianz Investment Management, Head of ETF Strategy. Good to talk to you today.
My pleasure. Thank you.
Coming up, want to bring your child to work every day? We'll find out which U.S. airport is offering childcare to entice workers. That's up next after the break.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
Now I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investors Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Mortgage rates ticking down slightly this week, but still remain too high for buyers and sellers to feel any bit of comfort. Yahoo Finance's Danny Romero has the numbers, and Danny, tale as old as time, still not great if you're looking to buy a home.
No, still really high. This is the 3rd consecutive week that mortgage rates are hovering over that 7%. The average 30-year fixed mortgage rate clocked in at 7.18% this week. That's what Freddie Mac reported. And to give you some context, this is the first time that this has happened since April of 2002. Higher rates are colliding with the traditional home buying season. So usually we see a slowdown right now and then it picks up again in the springtime. But the current environment still remains a major headwind for buyers who still want to be in the market, but also further cements the idea of homeowners staying put.
Danny, with mortgage rates still above that 7%, though, what does this leave home buyer?
Akiko, head over to the new home market. New construction made up 31% of the current inventory in July. The builders are ramping up construction and offering incentives. The nice cushy perk that they're offering is this mortgage rate buy down, which allows new buyers to take on a rate below 6%. So really attractive. And we can't forget that mortgage rates are to blame for the shortage of homes. And for those that already have a mortgage, there's really no incentive right now to take on something that's going to cost them more. But I will say, when will rates really, what's going to happen with rates going on from here? That's to be determined. Experts say that by September, when we figure out what the Fed's decision is going to be on interest rates, we might have a better gauge on that. But I do want to point out that Jay Powell said in its Jackson Hole speech that home prices, rent prices are still rising even after 11 rate hikes. Akiko?
Yeah, and Danny, I'll take it over here because I'm in the process of trying to potentially find a home, and it's not pretty out there. So Thank you so much. I know you'll keep it all tracked for us as we move forward.
Well, tight labor market and a boom in travel is dialing up the pressure to staff up at the country's airports. And as airports race to hire those workers, one way they're looking to attract employees is with childcare services. Pittsburgh International Airport among the list of employers devising new childcare plans. And here to discuss this and more, we have Christina Cassotis, Pittsburgh International Airport CEO. Christina, it's good to talk to you today. What prompted this offering? What did you see as you tried to staff up that led you to think childcare may entice more workers to come in the door?
We started this 4 years ago, way before we were worried about worker shortages as a result of COVID. So this has everything to do with the fact that as an aviation professional and somebody that I'd like to see a lot more people get interested in aviation, and I want to make sure we've got a nice steady pipeline of talent. This to us looked like a very smart idea in concert with our new terminal construction program in order to entice folks to want to work out here in either the construction trades, building our new facility, or on site doing any of the important work that we do every day at the airport. So started thinking about it in 19, put the project team together in 21, and we open on Tuesday.
And Christina, it's also important to note that for those participating employees, childcare costs will be 10% below area market rate. That's a huge cost savings. How important was that factor for your workers?
I don't think that's really the issue. Listen, airports are not usually located in city centers. This is really all about breaking down barriers to entry and about retention. I've got a great team. I'd like to keep them here. And we'd like to be attracting more folks who are interested in working out here, whether that's for us or any of the concessions for our cleaning company, et cetera. Sometimes this isn't the first place that people think of. So the more that we can do to eliminate barriers to entry, to getting folks out here, we're interested in doing. And yeah, the 10% is I'm sure it's a factor, but I don't think it's the main one. I think it's a lot more about convenience.
What does enrollment you've seen so far tell you about how big a factor childcare is?
It's a big one. So we're starting, rather, I would say modestly. It opens on Tuesday. We've been waiting for the state to finalize the inspection. And now we are expecting that enrollment will pick up rather substantially. So we'll see. We are saving some spots for folks who participate in our workforce development program. And we are also making sure that there will be slots available for people who qualify for state subsidized childcare at the people who may work for some companies where that would be appropriate.
And you said before how you want to create sticky benefits for workers, childcare being one example of that. What are some other examples?
Oh my gosh, we've got, obviously, we put in quite a while ago, we've got parental leave available to all of our team. We've actually worked on rerouting bus lines to make it easier to get to the airport with public transportation. We do quite a lot with workforce development, leadership development at the airport. And we are in the middle of building what we believe will be one of the best airports in the world. So we're counting on that whole pride in building something that'll last for the next 30 years. There's quite a lot that we're doing to make sure that people want to work out here, choose to work out here. So that involves training, involves transportation, it involves childcare, and it involves just awareness of what the opportunities are. We actually start with school kids and then work all the way up to folks who might want to be reskilled and retrained.
On childcare specifically, you think this is going to become the new norm when you think about benefits?
I wish it would. I wish it would. As my son is in college now, I would have loved something like this. And I think it's incredibly important for working parents. I think it's table stakes for all of us, especially in aviation and especially at airports, to really think about how we're going to make sure we make it easy for people to choose us when they think about their career plans.
And in terms of hiring, what have been the biggest challenges that you've faced? Does it come down to that flexibility and convenience? What are workers demanding right now?
We don't have that issue right now. We actually have a pretty long line for every position that we've got available. People want to be involved out here. So we have done what we can when it comes to flexibility, but we're an airport. You don't run that from your living room. So I would say that there are a lot of we've done as much as we can do around flexibility, around remote work. And but otherwise, it's just being involved in an industry that, makes the world go round. And people seem to really be attracted to that.
Pittsburgh International Airport CEO Christina Cassotis, good to talk to you today. Good luck with that opening.
Thanks for having me.
Really appreciate the time. Well, coming up, the closing bell on Wall Street, we're going to check in on the latest market moves and the top trending tickers. We'll be right back.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
That is the closing bell on Wall Street on this Thursday. Let's take a look at where the markets closed here. It was a bit of a mixed picture here, as we see the Nasdaq, the only one in the green right now, up about 18 points. The S&P 500 unable to notch out a fifth straight day of gains, closing the day down just 7 points, and the Dow down 169. Investors certainly digesting that PCE number we got this morning. That is, of course, the Fed's preferred inflation gauge, showing core PCE did tick up slightly higher, and it is still elevated well above that 2% target. We saw some yields moving on the back of that as well. Well, checking in on some of today's top trending tickers, shares of Palantir in the red today, down more than 8% after Morgan Stanley downgraded the stock to underweight from equal weight, warning of its lack of monetization strategy as investors begin to look for the revenue impact of these generative AI initiatives. Ali, that's kind of putting it mildly. Specifically, Morgan Stanley saying that the challenges Palantir has in monetizing AI could drive the share price down more than 40%. That is not what investors want to hear, especially right now when they're still trying to get a gauge of just how significant a revenue driver AI is going to be to companies like Palantir.
Yeah, investors are just becoming a lot more cautious overall. And if you're a company that can't utilize those initiatives to drive top line growth, to drive revenue over the next few months or next few quarters, investors would rather sit on the sidelines. So to me, this is very much a show me story, but it's crazy to think about where we are today in terms of that AI hype compared to where we were even at the start of the year, because it certainly seems to have dwindled. We'll see if these companies are able to deliver on that top line. But one company that I'm watching, which certainly hasn't had a problem with their share price today, is Okta. Shares soaring more than 13% after reporting a second quarter earnings beat and boosting its full year outlook. The software company saw revenue increase 23%, and they continue to deliver strong consumer growth, adding 125 customers with 100,000 plus annual contract value, bringing the total number to 4,000. And analysts really championed this report. The beat on earnings, you had improved guidance and just overall performance, especially when you think about where this company was a year ago and how they've been able to turn things around with leadership challenges, that weak macro picture. Now it all comes down to execution, but it seems like they have a solid foundation at this point.
Yeah, you know, Ali, I always like to repeat during earnings, but it really is true. So much of this is about setting expectations. Wall Street had gotten so bearish on a name like Okta, really the surprise to the upside being reflected in a big way in the share price today, up about 13.5%. It's worth noting here the number we've been watching, which is, of course, ACV. The company added 125 customers with $100,000 plus annual contract value, total base of 100,000 plus ACV customers now at 4,200. That's about a 20% growth. So certainly a very strong quarter for the company. Well, Chewy shares are down as the company warns of difficulties from a cost-cautious consumer. The company's second quarter earnings barely beat on revenue and missed expectations on adjusted earnings. The company's CEO warning the brand is not fully exempt from current macroeconomic headwinds. You know, Ali, anytime you start to see a bit of a pullback in pet spending, that's going to be a concern. But, you know, this is so much kind of what we were talking about earlier with Dollar General. It is also about the competition. And for Chewy, once again, you hear a name like Walmart really eating into some of the market share for the company. But you could argue maybe there's a bit of an overreaction on the stock, given where the quarterly numbers came in.
It seems like the big drag on the stock today was from those active users falling. They fell to 20.39 million, down from the prior 20.49 million from a year ago. So that lag in users, coupled with uncertain macro conditions, that's weighing heavily on investor sentiment. But you're so right. I mean, we talk a lot about whether or not a pet business is recession-proof, because I know some pet owners out there that are willing to spend whatever they can on their pets. I don't own a pet, so I'm not one of those, but to see consumers trading down, right? Buying dry food rather than wet food, not purchasing as many snacks or treats. That's something that's really interesting to me moving forward, especially since we're seeing consumer confidence levels tick down. And for the first half of the year, we saw a really confident consumer, and now heading into the back half, not so much.
Yeah, we know how much consumers are willing to shell out when it comes to their pets. So, it's an interesting trend to follow it as we kind of try to get a better gauge on, consumers that are turning cautious, where they're sort of trying to pinch pennies moving forward. Well, over the next few weeks, Yahoo Finance is taking a closer look at the Magnificent Seven and what investors should keep in mind with the biggest names in tech. Today, the focus turns to Meta. Up over 140% this year. Facebook's parent company is on a roll, but the stock still needs to rally nearly 30% to reach its all-time high. So how's it going to get there? Let's bring in Yahoo Finance's Ali Garfinkel. Ali, I'm keeping tally here. What are we on, number 3 of the Magnificent Seven?
We are number 3 of the Magnificent Seven. Number 4 and more will come next week, Akiko.
So let's talk about Meta. How much higher can things go?
So here's the thing. Yes, actually, 140% is a lot. But actually, since July, Meta has been slightly underperforming tech overall. I know that seems crazy, but what it means is that the central question on Wall Street has become this. How does Meta get back to those highest highs? Now, I want to be really clear about what I mean by that. The magic number that folks are looking for here, Akiko, is $350 plus per share price. Now, today, right now, as I sat down, Meta was trading at $295, $296. So that's really some space to really elapse here. And the answer, how do they do it? It's AI. Now, don't discount AI as a buzzword here. Experts are really telling me that it has practical applications for Meta. Think about it this way. Meta's an advertising business fundamentally before it's anything else. AI can help improve targeting, and generative AI in particular can help transform creative, making it a lot more efficient, both for Meta and for its customers. They are starting to leverage this already, particularly in their Advantage Plus product. And AI is key to Meta's ad business moving forward. Ultimately, ads is already a huge part of Meta's business, right? In 2022, Meta generated over $113 billion in ad revenues. And AI can make those numbers bigger if Meta can execute.
So what should investors do with Meta then?
As always, Akiko, I'm not going to give you a straight answer. I'm not going to say buy, hold, or sell because everyone has different risk thresholds. However, I will give you something to think about here. Because Meta has been slightly underperforming the rest of tech, as crazy as that sounds, there is actually a lot of comfort with the valuation that I'm hearing right now. Frankly, a lot of comfort that I haven't heard with the other Magnificent Seven. So this actually bears it out in the recommendations. Wall Street analysts overall say 59 buys, 7 holds, 2 sells. Now, important thing to say here, there are some regulatory concerns for Meta coming down the pike. It's actually not going to be from the FTC. It is going to be out of Europe. The Digital Services Act does go into effect in 2024. That's something that is going to affect how they run their business. But all in all, barring regulatory challenges really getting out of hand, Meta seems positioned for some upside.
Okay, Ali Garfinkel with a daily breakdown, we should say, of the Magnificent Seven. Thanks so much.
Hi, Lulu is out with its second quarter earnings results. Let's break down the numbers. As you can see, we have shares down more than 2%. We saw a beat on the top line, $2.21 billion versus the expected $2.17 billion, but a miss on the bottom line, $2.20 versus the expected $2.54. We have gross margins ahead of estimates, 58.8 versus the expected 58.6. We saw inventories increase 14%, while total comp sales, they increased 11%. There's no mention of shrink in this earnings report, but that has been a common thread among all of the retail giants. Lululemon, as opposed to some of its competitors like Dick's, often a higher end consumer. But right now, it seems like the big drag on the stock is that miss on the bottom line. We'll see if shares can recover somewhat, and we'll see what the leadership has to say on that call later this afternoon.
Yeah, some other things I'm watching right now, Ali, as I look through this release, inventories at the end of the second quarter increasing to 14% to 1.7 billion compared to 1.5 billion at the end of the second quarter. So we're talking about of last year. So year-on-year comparison there. And, we often forget that inventory drawdown still happening with discounts as well for so many of these retailers. Also for outlook for Q3, the company now expecting net revenue to be in the range of 2.165 billion at $2.19 billion. You know, Ali, with so many of these retailers, especially specialty retailers like Lulu, it is always a good gauge to see where the consumer is. They do sell at a higher price point. You know, earlier we were talking about a name like Dollar General and sort of discount and value, but this is going to be interesting to see, you know, where we are seeing customers prioritize, because increasingly we've heard from retailers that discretionary spending is really seeing significant pullback. I would put Lulu in that category.
100%. And you mentioned that outlook, raising their full year revenue guidance to that $9.51 billion to $9.57 billion. We're actually seeing shares in after hours start to tick up in positive territory. So perhaps because of that bottom line miss, investors pulled back. But now as they dig through this report, we're seeing a bit of a recovery in that stock. So again, it's all going to come down to the earnings call and the language surrounding the future, especially as we head into the critical holiday shopping season.
Yeah, the shares up just slightly, about 0.6% there. Well, coming up, we're going to get more reaction to Lululemon earnings, and we'll get third quarter results from chipmaker Broadcom. All of that and much more when Yahoo Finance returns.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investors Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Lululemon reporting a beat on revenue but missing on earnings. However, the company boosted its net revenue forecast for the year. Shares are trading flat in after-hours trading. Here to dig into the numbers is Brian Nagel, Oppenheimer Managing Director and Senior Analyst. Brian, what do you make of this report, especially in comparison to other retailers like Dick's, for example, which certainly struggled in the quarter?
Well, good afternoon. Look, I think this is a very solid report from Lululemon. We're just digging through these results right now, but I actually, if I'm looking at the numbers correctly, I think you actually had a modest beat on the top line and a modest beat on EPS as well. It looks like the EPS came in at 268, which is maybe a 10, 15 cents better than the street number. So, look, I think the results here from Lulu are very solid. Okay, now to tie that over with Dick's, look, there was some noise in the Dick's announcement. Particularly around shrink, and that's been an issue. A lot of these retailers now have been focused, but behind that, behind the shrink issue with Dick's, their results were quite solid as well. So what I think we're seeing here is, really overall within this sporting goods and this athletic space, very solid results, continued indications of solid consumer demand.
Yeah, what does that tell you, Brian, about where consumers are prioritizing things? We were talking earlier before the break about how much we've heard from these big name retailers about discretionary spending coming down. You're seeing strength, you're saying with Dick's, with Lululemon. What does that tell you about sort of the mind of the consumer right now?
Sure. Look, I've studied the consumer for a long time, a couple decades at least now. And I would say this is one of the most fluid, frankly, one of the most confusing consumer environments I've ever seen. And there's a lot of trade-offs, and it's definitely not one size fits all. Okay. So to answer your question, look, I think what we're seeing here is a discerning consumer. Post-pandemic, there's clearly this shift back in spending to services. That's travel, eating out, sporting events, whatever. And so to a certain extent now, that shift is impacting sales in categories that performed very well during the pandemic. But if you look at Lululemon, I think one of the big trends here is, so Lulu performed well through the pandemic, right? But I think what's happening here post-pandemic is, as a society, we are still dressing a lot more casually. So this ongoing strength in Lululemon, the double-digit sales growth, to a certain extent, is coming at the expense of more traditional clothing companies. Just because now we're dressing athleisure-wise, in more aspects of our lives, including work.
And you mentioned shrink and how that was a big problem for Dick's. There was no mention of shrink or retail theft in this press release. We'll see if it comes up on the call. But if shrink isn't a big problem for Lulu, why is that the case? Is it because it's in a higher end category?
It's possible. Look, it's an interesting question. Well, again, like you said, we're gonna have to see what they say on their call, because I'm sure it's gonna come up. But one piece, one factor is, a large portion of Lululemon sales are online. Okay, so that just by its nature protects from in-store shrink. But you also have a number of their stores are mall-based. Okay, so maybe there's better protections for these stores there. They're generally smaller stores. They've got a lot of service personnel in these stores. So all those factors can help protect the kind of shrink that we're seeing elsewhere, particularly more the big box stores.
I want to pick up on that point. You said a lot of their stores are mall-based. And when I think of Lululemon, I think of the mall. I think of these shopping centers. They are making advancements on the digital side, but we have seen a slowdown in foot traffic when it comes to brick and mortar. What's the outlook there? Do you think they're going to have to close more stores, or is that something they should be leaning in on?
Well, look, one of the big advantages of the Lulu model is, I've made this point for a long time now, is that they're really starting from scratch, right? I mean, this is truly a direct-to-consumer brand that uses the company's stores as a means to drive direct-to-consumer sales, okay? And that's very different than a lot of other brands and a lot of other retailers. You take Nike, for example. We're big fans of Nike too, but one of the challenges for Nike over the last few or several years now has been that they've had to sort of say dismantle or at least reconfigure their wholesale distribution network, as they had to think about with their partnerships in wholesale. Lululemon has not had to deal with that. Their wholesale business is very small. It's direct to consumer. A lot of it's online, and a lot of it's in their own store. So when they open a store, and they talk about this a lot. I mean, that store, acts as a place to sell product, but also very much complements the online offering, right? And that's how they continue to open stores in the United States as well as in markets across the world. So I don't see them closing stores. I think they're very much in an optimal position here as far as store openings because they're picking off the best locations and doing it smartly.
I can tell you're very bullish on Lulu. You have an outperform rating on the stock. What are your biggest concerns, though, as we think about the future, the uncertainties with the macro environment, potentially more interest rates? We are seeing a more pressured consumer. Is there an area of the business that you are a little bit concerned about?
Well, we can't ignore the macro environment, right? We can't. I mean, look, I'm of the view, and given my, kind of my perspective on the consumer, I think the consumer is holding in very well. Despite rather significant interest rate hikes and other pressures out there, but I think the consumer is holding in very well. Now, but one risk is we cannot ignore this. I mean, if the U.S. economy, I don't think it's going to happen, but if the U.S. economy were to shift into some type of more significant recession, here's Lululemon, and this is a high quality product. There's a lot of demand. There's a lot of passion around this brand, but it's high priced. And you got to think that if we went into a really significant consumer pullback, sales of Lululemon would get hurt. Okay, so that's one risk. The other fact, you got to keep competition. I mean, I think Lululemon's doing a great job within the athleisure space. I mentioned a moment ago they're taking market share from other kind of clothing brands. But look, it's a very competitive space, and the consumer has been historically fickle when it comes to this type of product. So we've got to see continued innovation from Lululemon. They've got to stay true to their brand to fend off this competition, either in terms of the major players like a Nike or a lot of the smaller players that keep on popping up.
Well, you're right about the higher prices. Those Lululemon yoga pants, they're not cheap, and I know that from experience. But Brian Nagel from Oppenheimer, thank you so much. Talk soon.
Thanks for having me. I appreciate it.
We are watching shares of Broadcom in the red in after-hours trading, despite a third quarter earnings beat on both the top and bottom lines. The chipmaker's fourth quarter revenue guidance came in just below estimates. Looking at that outlook, Q4 revenue, the company now sees at $9.27 billion versus the $9.28 billion that was expected. So just coming in slightly lower, but that does point to this continued sluggishness that we've seen in chip demand as well. Earnings coming in at $10.54 a share. That was a beat. Revenue coming in at $8.88 there as well, and that was a beat. But Hock Tan, the CEO of Broadcom, saying our fourth quarter outlook projects year-over-year growth, reflecting continued leadership and networking for generative AI. Now, Ali, it's worth noting we're seeing that stock down 2.7%, but this stock did hit a record high in the session today at one point at 923.24. It's up 65% year to date, and this is one of those companies that has really been swept up in this AI push to the top, as we've seen the investor exuberance take hold on the expectations about how significant a revenue driver AI is likely to be. Last quarter, we heard from Broadcom saying that sales related to AI will double this year. So they're certainly going to get a lot of questions about what that demand looks like moving forward, especially after we heard from the leader, NVIDIA, in terms of what kind of demand they're seeing there. But right now we are seeing the stock down. You could argue some profit taking happening, but also that outlook pointing to demand not quite there, looking forward to Q4.
And you mentioned NVIDIA, they had a blowout quarter, yet the initial stock reaction was meh. And it goes back to our early conversations about Palantir and all of these companies with AI exposure. the investor, they're just a little cautious right now. And again, it's that wait and see story down the line. So we'll have to keep tracking that. Well, coming up next, we'll hit some of the top trending stories of the day, and that includes a Taylor Swift movie. More when Yahoo Finance returns.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Welcome back to Yahoo Finance Live. I'm Brooke DePalma alongside Ali Canal and Prosty Remadian. We're taking a closer look at some of the top stories today. One that caught my attention, Kylie Jenner looking to buy back a Coty's stake in her cosmetics business. That's according to Bloomberg. Now, Coty bought a 51% stake worth $600 million back in 2020. And in addition to that, Wall Street already weighing in on this potential sale back to Kylie Jenner. Jefferies analysts saying that we believe the value of the brand is likely lower today than that $600 million that it bought it for back in 2020. They said that this will have debt pay down, which is a priority for Coty, and that the repurchase could help accelerate deleveraging efforts. Now, Kim Kardashian, of course, another media mogul in the family, is also looking to repurchase the 20% stake that Coty has in her skincare line, Skin by Kim. And so really this is a story of what we're seeing, a larger trend of these celebrities looking to take back ownership here. And certainly Kim Kardashian's going to have a much easier time than Kylie Jenner.
Yeah.
20% for $200 million versus the 51% for $600 million. And it's interesting to see the disintegration of this partnership because Coty at the time, they really wanted to expand both Kim Kardashian's business and Kylie Jenner's business globally, which they have done, but it seems like there's been clashes over creative control. So we'll see where this story goes. I will say personally, I think the hype around Kylie Cosmetics has really faded over the past couple of years. I remember when she would release new lipsticks, it was all the rage. They would sell out in seconds.
Yeah.
There was a lot of promotion on social media. I feel like it's pared back a bit.
I think that's sort of what it is, what she's upset about with Coty is not promoting her stuff the way that she had done it when she was in total control. And you know that 51% means that she has no say in anything, so they can do whatever they want. I guess it's very frustrating for her. You tell me, I mean, I'm not sure what Coty's doing from a promotional point of view, but it seems like that buzz, even I'm not a user, but the buzz seems to be gone. And remember, she was on the cover, was it Fortune, the first woman billionaire or something like that? It was self-made. Such a big deal, and now it's sort of quieting down.
Well, I say that nobody's a better promoter or marketer than the Kardashians themselves. I mean, you know, if you were a follower of this brand back in 2020, I was waiting to see Kylie's videos of her showing her arm, putting all the swatches, and people were tuning in by the thousands, by maybe even, dare I say, hundreds of thousands. And people were really looking to see how Kylie was using the skincare line, or rather the cosmetics brands, how it was playing into her day-to-day looks. And that really was half the marketing itself. And I think that Coty taking majority stake here, that sense of I use it too, and this is how I wear my colors day to day, has been lost a little bit.
Yeah, 100%. And it'll be interesting if she's able to do it. And like Jeffries was saying, the value of the brand could be less.
Right.
So what does that mean?
Right.
When it comes to repurchasing.
Right. And also like the founder's dilemma, right? You get that money, you get that big paycheck and cash out, but then what happens to your brand, your company? You're no longer in control, and you sort of see it kind of just maybe go on a path you didn't want. So sticking with women and power and things like that, I want to talk about, you know, we've seen college football games where you pack in 100,000 people in the Big House, for instance, right? Michigan, right? Well, how about 90-some-odd thousand for a women's volleyball game that happened at University of Nebraska? The team there packed in their football stadium there for a match against University of Nebraska, Omaha. They won that match, but also packed 92,000 fans. They say that this is the largest ever attendance for a women's sporting event in the history. Guinness hasn't commented yet, but that's what they're saying. So that's a huge accomplishment. I'm surprised that there's that many people to come to. I mean, for football, yes, but for volleyball,
packed out.
And it kind of, maybe it speaks to the power or more popularity of women's sports in general, I think.
Right, and just based upon the energy within that crowd, the photos that you're seeing, I mean, could this be a turnaround point? Could this be a pivot point in women's sports, support and really fandom that we're seeing? We've seen this for men for years, but now maybe some women are getting back into the mix here. And I mean, just the growth and the momentum behind other female athletes, like I can't help but think of Simone Biles and all the support that she's gotten recently. You know, we've also saw that hype around the Women's World Cup, but what we're missing here is really ad sponsorships for these athletes, research around what these athletes are getting when it comes to these sort of payouts. So really, while we're seeing these are great numbers at the stadium, what's next? Where are we going to take it from here is what I'm keeping an eye out for.
And to your point, Nielsen had a new report out that says women's sports viewership is on the rise, and that was ahead of the World Cup. So there is greater interest there. I do think there's also going to be more opportunities for women's sports. When you think about all of these media companies releasing their own streaming services, sports has been looked at as a really sticky component to that. So more opportunities to potentially broadcast these games. But I subscribe to the notion, and I even think back to my college days, if your team is good, if you have a really solid, good team and you're winning, people are going to go to those games. And I think with volleyball and the Nebraska example, that is why that was happening.
Yeah, I want to quickly add that this is no surprise because they actually sold out 300 straight games, I believe, at their volleyball center, because they're a very good team, very popular. So it wasn't a surprise that they would actually get this many people. I mean, it's still a big accomplishment, but the team was very good, and people were going to see them, and they're going to support them to that level of 92,000 fans.
Yeah, because I think back to my college basketball team, the Hoyas, which I, have a love-hate relationship with. They were so good year one. Everyone came to those games. Then they got so bad, and guess what? Not a single person went. Really, it really was very.
Even a program like Georgetown.
Even like a program like Georgetown, they weren't good. They weren't filling the seats. They weren't filling the stadiums, and that's just because no one cared anymore. So I do think that's a big element of it.
And think about the revenue that this could bring in for a college, and even gain support when it comes to opportunities for these players as well as equipment. This is going to be a big return for the players, and I just love seeing stuff like that.
Yeah, 100%. And it's August, and it hasn't been a cruel summer for some people, including Taylor Swift, who just wrapped up
and her
fans who just wrapped up the North American leg of her tour. And she just announced today, guys, that there will be a movie version of her concert that will hit theater chains October 13th. Earlier today, we saw a boost to theater chains like AMC, Cinemark, IMAX. And when you think about what this could mean for the box office, especially heading into the fall, when we're seeing the strike delay a lot of movies, the Dune sequel, highly anticipated, was supposed to debut in November. Now it's not going to debut until March of next year. There really aren't those one-off events, one-off films that will drive people to theaters. This certainly will.
Yeah, and Allie and I tried to go get tickets. Hate to break the news, but they are sold out here in New York City.
Crazy.
And I mean, it's absolutely insane just to think of the momentum behind the concert. And now to see a similar momentum already on day one, just announced today, behind the movie. I mean, people have the money to spend. They're willing to splurge on Taylor Swift. And this is sort of a cultural moment, perhaps like we saw with Barbie. People are going to be dressing up that day, wearing the friendship bracelets, and shouting, I'm sure, in the theaters as well. I know Taylor Swift hinted at that.
Singing along.
Exactly.
We were concerned, right, about the fall box office.
Right.
And then what happens? Taylor Swift to the rescue. I'm actually interested in checking it out. I didn't get to see the concert. I want to go check out the actual.
Same. I didn't get to see the concert either.
And the trailer,
the trailer
looks amazing. I mean, the way that look at this, like just the actual production quality. I'm not sure which concert they filmed this at, but it looks great. She's talking to the crowd, talking to the audience, I guess, and I think this is something that I think a lot of their fans can relive that. See multiple times.
Behind the scenes moments.
Yeah.
I hope there are behind the scenes moments. I mean, they didn't hint at that in the trailer.
Right. And you guys are saying that you guys couldn't even buy tickets, right? Yeah. So the ticket sites are crashing. So, I mean, it's already happening.
Hopefully, maybe they'll release more dates so we can get our tickets.
Absolutely.
So you never know, but honestly, a good thing for Swifties, a good thing for the box office, especially amid these strikes. But speaking of the Hollywood strikes, we have a story coming up on the other side of this break about one company who actually seems to be benefiting from those strikes. Keep it right here to Yahoo Finance. We'll be right back. Overall, a majority of Americans approve of labor unions, and 67% side with television and film actors amid the ongoing Hollywood strikes. According to a new Gallup poll, less than a quarter side with the studios. SAG-AFTRA members have been on strike since mid-July, and many are finding new ways to make money. Video message site Cameo has seen more than 2,500 celebs start or reactivate their accounts since the strike began. Here with more is Cameo CEO Steven Galanis. Steven, thanks so much for joining us here. We've rattled off some of those numbers, but how much of a boost are you seeing amid these strikes, and how does that compare to what you saw pre-strike?
Yeah, look, in the last 48 days since the SAG strike started, we've seen over 2,500 talent join or reactivate on Cameo. This is 180% month-to-date increase from where we would have been before the strike. And it's really the best time that we've had from a talent onboarding perspective since COVID, when every production was shut down.
Steven, what's been the conversation with SAG-AFTRA? Or I guess the question is, have you had a direct conversation with them? It sounds like there is some kind of partnership that's happening that allows for actors to be able to use, what they get from Cameo for Business to work towards those hours needed for health and benefit.
Yeah, that's exactly right. One of the things, back to your earlier point about, the public being really supportive of the actors here. 86% of SAG-AFTRA members did not qualify last year to meet the $26,500 threshold to make them eligible for their health care that they get through SAG. This has been a big problem. SAG has long been looking for other ways to give their members qualified earnings. And before the strike, a few months before the strike, we actually struck a first of its kind partnership where the earnings that talent make from Cameo for Business actually accrue to their pension and healthcare benefits. So this is a really big godsend to actors that otherwise aren't able to go do Comic-Cons anymore. They're not able to do merch drops if they have IP related to movies. They can't do personal appearances in many cases. So this has been really huge for them to be able to come back to the Cameo platform, engage with their fans, and earn a living.
Are you concerned at all that once the strikes end, you'll see a significant drop-off of those participants, especially those more high-profile names?
Look, we've seen this happen, as different things happen, whether it's COVID or, the disaster of the day. So anytime there's a natural disaster, for example, we'll see talent join to raise funds for things like the Maui wildfire or the hurricanes that are going on in Florida right now. So this is business as usual for us. On the aggregate, though, once people join Cameo, they tend to really like it. And our year gets busier and busier as we get towards Christmas. So, any pull forward that we see right now in supply side acquisition will be, good for the business in the long term.
Steve, to your point, you have seen the highs of the highs, really at the peak during COVID, to the lows where you've had to undergo a number of rounds of layoffs in terms of your employees. This has got to be a positive, and I know you're saying this is temporary, but how do you as a company ride this momentum when you've got more eyes on the platform right now to try and keep this going?
Look, we've struggled with a lot of issues, just like other tech companies, that had big bumps during COVID. If you look at how our business was before COVID and where it ended up today, I think anybody would have taken that straight line back in 2019 to where the business is in 2023. But when you go all the way up and and have it come back down, it's certainly a much more turbulent path than we're all thinking. As far as what this means for our team, look, we have a small but mighty team right now, but this is just more evidence to all the talent on the platform, our investors, the industry in general, and our employees. Cameo's really become like a public utility in Hollywood. We're there in the good times, we're there in the bad times, and it really is a platform that matters, and that's the thing that is probably most important to our team going forward, and it's what gets us up to go work hard every single day.
I myself, Steve, I've purchased 2 Cameos in my life. They were for two different friends, pretty far apart. But it got me thinking about how the novelty sort of wears off after you buy the first one. So what ways are you working towards to try and attract that repeat customer? Is that an issue you're facing at all?
Look, we at this point have sold, single-digit millions of Cameos. So there's 8 billion people in the world, and I think we have a long way to go before Cameo doesn't become special. We get the reaction videos every single day, and the brand awareness is only 14%. Only 14% of Americans in our core demo know what Cameo is and have unaided recall of it. So we've got a ton of upside to go on that front. But you have asked a great question, and so much of what the effort that we are working on right now is seen at retaining talent and retaining customers and making sure that they have an insanely delightful experience. And again, that's what we work towards every day.
Steve, you've been very transparent about the challenges you've had to face in your company. And to your point, I mean, sure, you're not the only tech company that really scaled up massively during the pandemic and have had to downsize in a big way. When you think about where the company is right now, is this kind of more in line with how you want to grow? In other words, it's not a company where you had hundreds and hundreds of employees. You've got a limited number. You're a smaller operation. But is this sort of more in line with how you envision the growth to be?
Look, the company's lean and mean right now. We are on path to be break even very soon, which is a huge milestone for us. This was a business burning millions of dollars a month only a year and a half ago. So we've taken huge strides. We've got a small but dedicated team that is fired up about our mission. They love our vision. They love the culture that we have here. So, we're doing everything that we can to make sure that this is as fun and a rewarding a place to work as it possibly can be. And we want to make sure that from our customer side and our talent side, they don't notice any degradation of having a much smaller team. And, huge props to everybody on our team that's really, been doing the job that many people were doing to keep it business as usual for everyone, especially during a period where we're seeing a big spike.
And to follow up there, Steve, you've made some recent acquisitions like the celeb merchandise platform Represent. Is there more M&A in your future?
Look, our ears are open, and the whole larger creator economy. I'm an investor in a lot of the companies, that are there. Right now, if you're not an AI company, it is tough to raise money, and I believe there'll be a lot more consolidation in this space over the next 18, 24 months. So our ears are open. We're constantly looking for things that can help with distribution that are accretive to our core business, and we'll continue to be aggressive as we can be.
Stephen Galanis, Cameo CEO, thank you so much.
Thank you.
Coming up, it's closing time here on Yahoo Finance. We recap the top stories of the day and get you set for everything you need to know tomorrow. Stay tuned.
With Labor Day weekend fast approaching, millions of Americans are going to the skies and the roads. According to AAA, domestic bookings are up 4% and international bookings are up 44%. But after a rough start to the summer travel season, we have a look at whether travelers may be in for a similar fate. Joining us now is CBS News travel editor Peter Greenberg. Peter, we've got the FAA predicting this is going to be the third busiest holiday weekend. How smooth are things going to look?
Well, you know what? Weather notwithstanding, demand is actually starting to decrease. People are starting to stay home a little more because they couldn't afford the airfares. They couldn't afford the hotel rates. So you're seeing airfares right now down about 11% from where they were about 2 weeks ago. And that's a good sign leading into the fall. Now, having said that, this is the last big hurrah weekend for the year leading into Thanksgiving. So people will be on the road. They will be taking to the skies. It's the usual chaos because all year long, it's not really seasonal. Flights have been full. Airports have been crowded and sometimes overcrowded.
And for many consumers, the Southwest meltdown that we saw in December is still top of mind. We also had multiple delays this summer amid pilot and other labor shortages. What does that mean for this weekend and looking beyond into the back half of the year when it comes to some of those potential disruptions?
Well, beyond pilot shortages and computer meltdowns, you've got a lingering problem with the FAA. 3 of the 4 major air traffic control centers are below their 85% staffing threshold, which means even in the best of weather, they have to slow things down because they literally do not have enough controllers to work the number of flights the airlines have scheduled. So you can expect delays just on that alone, then you throw weather in. So let's just hope there's not any weather. It'll just be slow.
Peter, you mentioned that we're already starting to see some consumers pull back from their travel plans this time of year. What does that suggest in terms of how things are going to look come holiday season? That is another big driver for so many of these airlines.
It is, but we have to go back to the COVID days where so many of us came up close and personal with our own sense of personal mortality and made a decision that we were going to forego expensive material goods and new cars and clothing and jewelry. We wanted to focus on buying experiences. So all that money that was saved up during COVID was spent on that. Here's the problem. We've blown through those savings and now we're putting it on our credit cards. As you have already reported numerous times, I suspect consumer credit debt on credit cards is over $1 trillion. So part of that weakening in demand is because people are getting their credit card bills at 24% interest and trying to reassess what their priorities really are.
And amid a lot of those higher prices, is there anything the consumer can do to try and score better deals?
Yes, the good news is as demand is falling, we're now starting to see drastic reductions in international fares. Just about a month ago, a round trip ticket from New York to London in coach was about $2,200. That's crazy. Today, I'm seeing fares starting now, not just waiting for Labor Day, down to $208 each way, and that includes taxes and fees. That's a remarkable change.
And finally, Peter, we've heard so much from these airlines about the strength they're seeing in international travel versus domestic. What are you seeing going into this weekend? Where are travelers going?
Well, most of them are not going internationally. They're coming back from their foreign vacations. Most of them are staying home, close to home because of school seasons and having to start the season after Labor Day. But if you want to be a smart traveler, now's the time to book international flights. As I said, that $208 example I gave you is just one of them.
Okay. I'll have to get some notes there on where to travel internationally. CBS News travel editor Peter Greenberg, good to talk to you today. Appreciate the time.
You got it.
It's closing time here at Yahoo Finance. Here's a look at some of the top stories of the day. The Federal Reserve's preferred inflation measure edged higher in July, reversing some of the prior month's sharp drop, with both core and headline PCE coming in line with economists' expectations as the central bank works to bring inflation back to its 2% target. Mortgage rates ease back down this week but remain above 7%. The average rate on the 30-year fixed mortgage declined to 7.18%. That's down from the 7.23% the week prior, according to Freddie Mac. This marks the third straight week rates have been above 7%, the first time that's happened since April 2002. And the cruel summer of Taylor Swift isn't ending anytime soon. The billion-dollar tour that has dominated the year is coming to movie theaters. Taylor Swift, the Eras Tour concert film will be released in the United States, Canada, and Mexico on October 13th, and is sure to keep all of the Swifties happy entering into the fall.
It's a concert tour that keeps going, Allie. Here's a look at what to watch tomorrow, and all eyes will be on the August jobs report. The expectation is for 170,000 jobs added, and the unemployment rate to hold steady at 3.5%. Wages are expected to rise 4.3% when you compare that from a year ago. It comes after ADP private payrolls showed a bigger than expected slowdown in the private sector hiring in August. This will be the last monthly jobs report before the Fed's September meeting, and markets are pricing in a pause. We're going to also get data points on manufacturing activity and construction spending. Plus, Cleveland's Loretta Mester is set to speak tomorrow at a conference in Germany. It'll come after Atlanta Fed President Raphael Bostic said Thursday that interest rates are high enough and current policy is tight enough to bring inflation down to 2%. It is shaping up for a very busy Friday filled with economic data, but that'll do it for Allie and I in today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. We'll see you then.